If your mortgage is coming up for renewal and you have two offers sitting in front of you and you're trying to decide which one is the best for you, this video is for you. I've sat across from hundreds of Canadians at Renewal, and I already know what they're going to do when they bring me these two options. They want to pick the lower interest rate because that's simple. They look at the lowest rate, they pick it, and they feel good about it. And for some of them, that's going to be a huge mistake. Not because they weren't careful, but because they fell into what I call the comparison trap. They're comparing the right things, but in the wrong order. So in this video, I'm going to give you 3 questions to ask before you even look at a rate to determine what options you should choose. And by the end of it, you're going to be able to compare 2 options in front of you and be able to decide what option is best for you. Because not always is the cheaper option on paper the cheapest option for you. Let me tell you a story about Mark and Sarah. They were up for renewal. They brought me 2 separate options. They had a rate of 4.64% with their current lender. And the best rate that they could get elsewhere was 4.89%. They thought their decision was super clear. They were going to choose the lower interest rate at their current lender. And I know what you're thinking. The higher interest rate might make sense if you're looking to break your mortgage and you have a lower term. No, these were both 5-year rates. So they ended up choosing the higher interest rate. And why did they do that? Well, they were able to ask one question. What happens if I need to break my mortgage early? And here's what's interesting. Most people, they don't expect to break their mortgage during their term. And there's stats out there from some brokers that say the vast majority of people break their mortgage. I don't know that to be true, but I do know when I worked at one of the biggest mortgage companies in Canada, they told me that the average person stayed in their mortgage for about 3.6 years. So not that the vast majority of people break the mortgage, but it does happen more often than the everyday person believes happens. And look, people don't break their mortgage because something goes wrong. And I hear this a lot. Look, I'm not worried about losing my job. I'm not worried about having to break because I can't afford it. But that's not always what happens. In some cases, you get a job promotion. You want to move to a different city. The other thing that might happen is you might want to upgrade your home. All of these things cause you to change your mortgage. And look, at a lot of these situations, you can't just switch your mortgage from one place to the next. You have to break. And breaking your mortgage, it costs money. And here's the thing though, that not all penalties are created the same. But before we get into that, let's talk about the difference between fixed and variable rates. So let's follow Mark and Sarah. We had a conversation about what interest rate they should take. We went through a bunch of different questions and they were scared. We had just gone through a huge rate increase in the market and they didn't want the variable interest rate. Now, just being scared is not a good reason to avoid variable interest rates, but there are actual reasons why you should. The first being is if your payments were to increase by $100 or $200 a month, and that would cause huge issues with your budget, then the variable interest rate probably isn't for you. The other thing is if the chance of fluctuating rates makes it so that you have heart palpitations and can't sleep at night, then the variable interest rate also isn't for you. Look, fixed rates are often higher in the long run than variable interest rates because the banks have to get a premium for guaranteeing the rate for you. It doesn't mean that's always the case, but just historically over the last 30 years, for the most part, the variable interest rate has been a better option. However, paying for that peace of mind, again, a couple of dollars here and there, is worth it for so many Canadians. On the fixed side allows for you to lock in a payment. You know exactly what your payment is going to be until the time that you've agreed with your lender is over. Like I said, it removes a variable from your life, and sometimes that's super important. But getting into a long term when there's a possibility of breaking your mortgage probably isn't your best option. So the question isn't which one is better. The question is which one is better for your life. Look, if you were to see a 1% or a 2% increase in payments, and that will cause you to lose sleep, or even worse, lose your house, then it probably doesn't make sense to go variable. At the same time, if you're looking to make changes shortly, we should not be taking a long fixed term. So in the case of Mark and Sarah, did they take a variable versus a fixed rate? No. Not only that, but they both took a 5-year fixed. So how did paying more money end up saving them in the long run? Well, in this case, it's important to look at how penalties are calculated. There's 2 different penalty types. Variable interest rates are guaranteed to be 3 months of interest. This one's pretty simple. You take your balance, you multiply it by your rate, and you divide it by 4. That gives you your 3 months of interest. On the fixed side, It's either the 3 months of interest, if that's higher, or what's called an interest rate differential. And it's a very complicated word. It means the loss of interest. Okay. And this might still be confusing. So let me break it down one step further. A loss of interest is like this. If the bank lends the money again after you break your mortgage, can they make more money or less? So let's say your rate is at 5%. If they can re-lend that money at 6%, then the loss of interest penalty is not going to apply. They can make more money by lending it out. However, if you have that same 5% interest rate, but the rate that they can now lend it out at is 4%, that's a 1% difference. And that is what you would need to pay over the remainder of your term. Now, they don't just use the term that, so if you took a 5-year fix, they don't always compare it to the 5-year. They compare it to the closest term. It's a little bit confusing, but in this case, the simple fact is if they were to re-lend the money out, would they lose money or would they make more? If they lose money, that's when a loss of interest penalty can apply. In this case, the penalty for their mortgage was only 3 months of interest. They paid $2,200. We had ran the other scenario through our mortgage monitoring system to calculate their penalty. We found out that they would pay over $11,000 if they had chosen the cheaper interest rate. So how is that? The comparison rates should be pretty close. Well, not all loss of interest penalties are calculated the same. The way that we calculated it seemed pretty normal. You take the rate that you have and you compare it with the rate that's being offered. But what banks will do is they'll offer a higher interest rate, let's say a 6% interest rate, and say, I am discounting that rate from 6% down to 4.64%. So I'm giving you a discount of 1.35%. Now, when they calculate the penalty, they factor in that discount as well. And this is where penalties can increase even though overall rates have not gone down substantially. This is the difference between this 3 months of interest penalty and this $11,000 loss of interest penalty. So what should you do? Look, we've explained a lot of things, but you've got to be wondering, how does this apply to me? Ask these 3 questions and this will simplify how you can choose what option to make. I call this the personal mortgage stress test. Look, the government stress tests your mortgage. You might as well stress test the bank's mortgage offer. The first question is, how does your lender calculate penalties? If they talk about interest rate differential or loss of interest penalties, ask the question, do they use posted rates or not to calculate the penalty? Question number 2, what could realistically change in my life? I'm not talking about what you expect to happen, but what you would say yes to. This is things like job changes, relocations, possibly moving up into a new home. All of these things, although they might not be 100% chances, can increase the probability of breaking your mortgage. If enough of these stack on top of each other, taking a long 5-year fixed rate is probably not the option for you. And the third question is, what is the trade-off? And the question is the rate difference worth the flexibility? I'm not here to say you should always avoid posted rate penalties. What I'm trying to say is you need to just include what the penalties are going to be in your calculation. If you're extremely stable, you're going to live in your house forever. There's no chance of moving. You're retired. You're going to stay in your home for 20 years. Then taking a 5-year fixed rate with a posted rate penalty might be worth it for you. It's just something that's important to consider the trade-offs. And if you want to find out what would I be saving, just take the difference in interest rate, times it by your balance, and then multiply that number by the number of years in your term. That's how you find out the total savings. If that difference is pretty small, you don't feel like it's worth the flexibility, then it might make sense to take the higher interest rate. Now look, here's the problem. You can't actually calculate the loss of interest penalty in advance. It's based off of the rate that's available at the time you break the mortgage. So all you can do in this case is look at historical trends to see what the difference in penalties might be. I like to think of this like a game of chess. The best move in front of you might not be the best move in general. Like grandmasters will sacrifice their queen if it means winning the game. And I think that mortgages are like this as well. In some cases, choosing something with a higher interest rate can actually mean winning in the long run. Now, that's not always the case. Sacrificing your queen on every play and taking that risk can end up losing you a lot more games than you win. So it's important to factor in all options. options. So instead of asking which one's cheaper, ask which one fits my life better. Fixed rates, variable rate. How do they calculate the penalty? And is that trade-off actually worth it? You know how to run your own mortgage stress test now. And that's not nothing. Most people sign their renewal without asking any of those questions. They walk in, they compare the rates they sign. And for you watching this video, you will not be that person. But here's what's still missing. Even though you know exactly how to compare interest rates, you don't know how to get the best rate. And to learn how to get your bank and your broker to offer you the best rate is a skill that's worth learning. In this video, I show you exactly how to do this. And if you like this content and want to subscribe, click the subscribe button right here.